Hello, my fellow investors. Here's a lecture from Chuck Akre at Talks at Google. It's a 58-minute lecture. I had here a few takeaways from this lecture. And Chuck Akre has been beating the market for a few decades. And anyone who's beating the market for a few decades, it's worthwhile to listen to him. So I just made here a few takeaways out of his entire lecture that I liked and that I learned from his lecture. I'll start off with his three-legged stool investment strategy, the way he likes to call it, so you can listen to him.
And so I was looking at that one day, and I thought, that's actually a perfect construct for our notion about what makes a valuable investment. We call it the three-legged stool. So if you looked at our material is resplendent with these three-legged stools. And the first leg of that, and we just use this as a shorthand version, a construct to help us think in very simple terms about how you find these great investments. So the first leg is this issue of a high return business, an exceptional business. MasterCard is an exceptional business. The average business earns, call it 8% after tax on earnings, and MasterCard earns 34%. That's exceptional. Even if the average were 10% would be exceptional, but MasterCard's 34%, my God, it's really incredible. So the first leg of the stool that we talk about is the quality of the business enterprise. And we spend a lot of time going down this road that we call, what's the essence of this business? What is it about the business that's causing this unbelievable rates of return to occur? The second leg of the stool then goes into the operations. It has to do with the people who run the business. And the shorthand version of that is we want them to have both skill and integrity. But what we say is that they've got a demonstrated record of being just killers at operating their business. But in addition to that, they treat us as partners even though they don't know us. It's a really important idea because the reverse of that is somebody I heard described the other day is talking like Warren Buffett and acting like Ronald Perelman. And there are people out there, and you'll find them, you'll run across them, who do whatever they can to make sure that public shareholders don't get their fair share. And we don't want that. We want the same thing happens at the company level to happen at the per share level. And that these are wonderfully skilled operators as well. So first leg is the quality of the business. The second leg is really the quality of the people who run the business. And then the third leg is the issue that really helps create the value, and that's the reinvestment. And there's a book out pretty current now called Dear Mr. Chairman, or Dear Chairman. And it's about activists and companies and trying to change the behavior of companies typically because of their reinvestment histories. And if a business has...
So I had here two great takeaways from his investment strategy. The first one about being a great company is that it's not enough to have a great company. You also want to understand why is the company so great. And I think this is a big point a lot of investors miss. They can find the great numbers, you can find all these financial ratios, everything looks good. But if you don't understand what's behind it, why is it so great, then you're missing a huge understanding of the business. Maybe it will change tomorrow. So to know a company has good numbers without understanding why it has such great numbers isn't enough. And his third stool, that the company has an option to reinvest its money in its business, that's great. But the thing is, if you have a company that has the first two legged stools, the great business and the great managers, and the company can't reinvest its business, its earnings in its business, then that'll be a problem. And he wouldn't invest in such a company. But let's say if you take someone like Warren Buffett and Berkshire, then you have the first two legs, which are great business and a great manager, but he can't reinvest in his company. So he's taking all his earnings and reinvesting it in other places. So that's where might be a problem with his third stool. But I have here another few takeaways from his amazing lecture. You can listen to it. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.
So in that issue about investors, what makes a great investor, and one of the things, you ask yourself, do you take undue risks? How do you define the risks? How do you tell? Have you lost a significant amount of money in an investment? Why do you think you've done that? All of these are important as we develop our skill as investors. And as I said, I had the advantage of a clean canvas. That is, I knew nothing when I came into the business.
So my biggest takeaway from this, what he's saying over here, is that he had the advantage of knowing nothing. And I think this is another thing, that people who don't know nothing about investments, they think because they never learned anything about investing and about the stock market, so they have a disadvantage. It could also be an advantage. If you know nothing, you have a clean canvas, and you actually might be have even a better chance than an average person who knows a lot about business, because you're learning everything from scratch, and you don't have any ideas that this is the right way to do it, or this is the right way to do it. You're learning everything from scratch the way you understand it. I think it's a great advantage. And of course, it's very nice what he's saying over here about you have to always check yourself if you're making mistakes. Why are you doing these mistakes? I think that's also a great thing. People need, investors need to check themselves the whole time.
So I had, in effect, really a clean canvas as to where I should go and what I should do. And so since I knew nothing, my goal was to figure this out. And the investment puzzle started out with, what makes a good investor and what makes a good investment. And I read voraciously, and still do. And in the early works that I read that were very important to me were books like John Train's The Money Masters. It was the first written story about Warren Buffett, other than a Forbes magazine article and that sort of stuff. And in that, Buffett outlines the only place that I've ever seen it. He gives the characteristics of a great business and the characteristics of what makes a great investor. And that was a very important book to me. I read things like The Intelligent Investor, Ben Graham wrote.
So over here, I also had a very big takeaway, and I think a lot of investors, a little bit, they miss this point. If you want to do cigar butts, then Benjamin Graham is great, excellent. If you're looking for growth stocks or good companies, or great companies, then you have to know how to analyze a business. And you can see over him, he's an investor who's interested in compounding machines, the way he calls them. He's known for his compounding machines. And he liked more the Money Masters than the Intelligent Investor, since it explains what's a good business, what's a good investor. Cigar butts is just a great investment. It's a one-time thing, but not a great business and a great investment in the long term. So this is another takeaway I had from his lecture. And to continue on the point of business analysis, he says another great thing. Listen to him.
I also read, then and still do, lots of business biography, because it informs me about human behavior, how people behave in their business life and business world, and how that affects what they're able to do.
Now here he is explaining the power of compounding. Maybe some of you know it, maybe not, but it's always nice to hear it again.
When I get around to compounding, I always use the example, you all have seen it on the web, about the penny. And so I'm going to ask this engineer right here, would you rather have in this hand $750,000 or a penny doubled every day for 30 days? So you want the penny, right? And I knew that. So instead of $750,000, I'm going to make it $2 million in my right hand versus the penny, doubled every day for 30 days. You still want the penny. So I figured that. How about $2 million one? Well, I mean, it was, this choice, it was $2 million before. You still took the penny. I'm saying, how about if I make it $2 million one?
That's a lot of money. I picked the $2 million.
Yeah, see? Now, who knows right off the top of the head what that figure is?
10.8 million.
Yeah, it's 10.8 million. It's 10,737,000 or something like that, some change. And
so that's just for people who don't know this. A penny that's doubled every single day for 30 days, the amount will come up to $10 million. That's the power of compounding. So it's always good to remember this thing. Here's an amazing thing he's saying about Peter Lynch that I never knew, and I really liked it. It's another strategy I never heard of, and I really liked it.
Peter had an unusual, do you all know who Peter Lynch is? He had a really unusual talent. He had 1,200 securities in the Fidelity Magellan Fund. He ran it for 8 or 9 years and had a phenomenal record and so on. But he had 1,200 securities. I mean, imagine. So I was in seeing him one day, and what he would do, we were talking about this earlier, is if he found an industry that he liked, or he would buy every company in that industry, put them in his portfolio, and then he'd eliminate them one at a time as he kept honing in on who were the best ones and so on.
Okay, that's an amazing story. I don't think most people can do what Peter did. That'd be a lot of work, but that just shows you how much options there are in value investing. So Peter Lynch did one thing. I really like this. I never heard of it before. And it's another amazing thing we can learn of another kind of strategy to use. Here's another great takeaway. Everyone should remember this. It's always accurate for everyone.
And then I say, just because you have a big brain doesn't mean you could be good at investing. And that's an important thing too.
That's always, everyone knows it, that all the great investors say that the most important organ in investing isn't the brain, it's the stomach. Peter Lynch says it, Warren Buffett, Benjamin Graham, that's a famous saying. And he just says it another way. And this is my biggest takeaway, because I really, really like it, and I think a lot of people need to remember this. And a lot of investors are trying to copycat someone else, and I think that's a big mistake, and they learn it the hard way. You have to be yourself. Don't try to be like Warren Buffett. Don't try to be like Peter Lynch. Learn from them all, and then figure out what's your right way to invest. This is, I think, a very, very important message. A lot of, especially young investors, learn after too much of a time which they didn't do the right way. So here, listen to him.
And that's an important thing too. And finally, there is no correct answer. There is no correct way. This is just the way that works for us. I'm happy to have the opportunity.
Okay, that's my takeaways from this lecture. I really liked it. And I think my goal is listen to as many great investors as you can. Learn from everything something. And the more you learn, the more you could become a better investor. Find out what's good for you. I think that's a great way to get into investing. Thank you very much, and hope you enjoyed this video. Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.